Hi everybody, my name is Tom O'Shea and this is a very quick video to explain some of the changes that are going to come into place for superannuation. So in May, the government released its budget, which had heaps of superannuation changes. Some of them upset a lot of people. So since May, essentially, they have amended it to make it more palatable for people in both parties, and essentially proposed a whole bunch of changes that they brought through Parliament a number of weeks ago. And on the 23rd of November, it's now the 25th of November, on the 23rd of November, they got through Parliament. So that doesn't make them law yet, but the only thing that needs to happen now is for royal assent to be achieved, and that will happen. That's normally a formality. So there's going to be a bunch of changes which will apply on most of them from the 1st of July 2017. So this video is just to give you a really quick snapshot of the most important of the changes. I do have access, or I can direct people to the website that has all of the changes in detail with good examples and things like that. But this is just to go, oh look, that might affect me. I need to look into it more. That's the idea of the video. So first one, right now, depending on your age, you can make up to $30,000 or $35,000 of concessional contributions a year. Let's just call those pre-tax contributions to make it easy. The government is reducing that to $25,000 a year, so will affect quite a number of people. So some of the bigger income earners, even regardless of their age, but then obviously the people who are getting closer to retirement and trying to bump up their super might be making quite large contributions. That will certainly affect them. Fortunately, they're bringing in another rule which says that if you don't use your full cap in 1 year, you may be able to use the bit you missed out on in future years. So that might provide benefit in future years, and it also has dependent on the balance of your super. You can't do that if you have over $500,000 in super, I think that's suggesting. So there's a couple of really significant changes. Also, at the moment, you cannot claim tax deductions for personal contributions if more than 10% of your income comes from employment income. So basically, to keep it simple for people, if you are employed, you're very unlikely to be able to make a contribution to super from your bank account and claim a tax deduction. They're removing that whole employment 10% thing, so that will become an option for a lot more people, which is good. It will make us much busier come end of June, but that's something for us to deal with. Another change they're bringing up is, right now, at the moment, you can stick in, depending on age and things like that and work status, but certainly if you're under 65, you can stick in $180,000 of your money into super as an after-tax contribution, a non-concessional contribution, and you can do 3 years in one hit, so you can use 3 years worth in one go. They have proposed, and they will bring in a change to that to make that only $100,000. So that is really significant for people who think there's some likelihood that they're going to want to chuck a chunk of money into super over the coming years. Maybe people are downsizing their house, maybe they're receiving an inheritance, whatever it might be. For people planning on putting a nice big chunk of money into super, you need to be looking at what rules are going to change, and whether you should be doing things this year or waiting, and how the limits might change. So really quite important. Another rule they're changing is that people are not allowed to have more than $1.6 million in the pension phase of super. So normal super, when you're building up, has a 15%, we'll call it for argument's sake, 15% tax on the earnings of the fund, if it's an accumulation fund, building up, adding to it, things like that. When you move into the retirement phase of super and you're drawing an income from it, the tax is zero. The government now says that from 1st of July 2017, you will only be allowed to have $1.6 million in that tax-free environment. The rest will have to be in the other environment, the 15% tax environment. So look, that won't affect too many people. It will certainly affect some, but that's another change coming up. They are also, another big one is a number of people, quite a lot of people, who are approaching retirement, so before 65, and you would be between 56 and 65 if you're doing this, will have a pre-retirement pension. So that's a superannuation pension, a superannuation fund that you're drawing an income from, but you're limited to how much you can draw. You can't draw as much of it as you want. At the moment, that type of pension, like all types of superannuation pension, the earnings are tax-free. That's changing, and that's going to be going back to 15% tax on those earnings as of next year. So a lot of people use that strategy to help build up their savings prior to retirement. It will still be valid for some, but may not be valid for others, or certainly be less beneficial. So I do have a bunch of clients in that scenario. We'll need to redress the strategy going forward to make sure that it's still relevant given the new laws. They are the main ones I want to talk about. There's also the fact that higher income earners, so over $300,000, used to pay more on their contributions to tax. They're reducing that to $250,000, so there'll be a greater bunch of people captured with that higher tax on contributions to super for the pre-tax contributions. They're removing anti-detriment payments, which I won't go into. There'll be more people can get a tax benefit for spouse contributions because I've made some changes to limits there, and they've changed the low-income super tax offset. So there's a few other changes, but some of the major ones are changes to caps on your pre-tax contributions to super, changes to the limits on after-tax contributions to super, changes to the tax treatment of pre-retirement superannuation pensions. They're kind of the main ones. So look, this is not supposed to be all-encompassing. I can certainly provide a link to Treasury website which has all these in detail with good examples and things like that. But if you've got any queries, feel free to contact me, and feel free to share this video as well. It certainly, if it's not relevant for you, it may be relevant for your mum or your dad or your brother or your uncle or whatever the case may be. So feel free to share it. Hopefully you got some benefit, and hopefully it was a bit more palatable than reading all this stuff in a nice big long email. Thank you very much.